What's going on, Dividend Chasers? Dividend Bloodhound here with another investing episode. In this episode we're going to talk about UK investing once again, and we're going to hit 3 UK technology or tech sector stocks, all available on the FTSE 100 or the FTSE 250 for you to buy and add to your portfolio as you so wish. I'm not a financial advisor, but these companies have got, especially the first one, have got some excellent history in the past, and a lot of people value them very, very highly. That being said, if this video brings you some value, please hit the like button in the corner over here. You have no idea how much that helps me out, and it helps the channel out. And if you're brand new here, please hit the subscribe button in that corner and even hit that notification bell as well. That would be absolutely fantastic, because obviously, of course, you want to get notified when you get brand new content just like this to help you out with your investing portfolios. That being said, let's get in there. Let's have a look at the first stock, and the first stock is Sage. Hello again guys, welcome into the analysis part of this video and into the app. And the first company we're looking at is Sage Group. This company, this tech company and software company, is not just based in the UK but also globally across literally all the world: North America, Europe, Central Europe, France, the Middle East, Asia and Latin America. I don't think there is much of the world left untouched by this company, and it diversifies down its sectors into, just to name a few, the cloud, which we all know is a big element of tech companies right now, with companies like Amazon, Microsoft, Apple all running their own competitor services. It has CRM management, accounting, Intel and Sage People, amongst others, that is there to help businesses manage their employees, manage their money, etc. Let's have a look at the fundamentals of this company then. So its ticker is SGE. It has a market cap of 7.35 billion. A PE ratio of 23.19, revenue of 1.94 billion, earnings per share of 0.29 pounds or 29p, and a dividend yield quite juicy at 2.53%. It has a net income of 266 million pounds, a profit margin of 13%, almost 14, and a low debt to assets ratio of 55%. It's been doing pretty decent recently as well. So its five-year revenue growth is 10.39%, and its 3-year growth is 7.42%, just shy of double digits for both factors. EPS and efficiency is just slightly lower at 6.7% and 11.29% respectively, and its compound annual growth rate is 5%, which is actually pretty good in my opinion. And then it has a dividend growth over the last 3 years of 6%, which is good by my book, and it has been growing its dividends now for well over 20 years plus, which makes this company a dividend aristocrat, moving on to dividend king status. Is currently trading at £6.77 a share. It's peaked just before the crisis at £7.92 and dropped peak crisis to £5.31, which would have been a bargain price to pick up at and would have boosted your yield considerably. This company is one of my favourite UK tech companies. I've only managed to add a small position to my portfolio at the moment, but I'm certainly looking to add more in the future. That being said, that wraps us up for Sage, and I'll see you in the outside world for the introduction of the next stock. Catch you there. What's going on again, guys? Welcome back to the real world. That was our first company then, Sage. Very, very, very good company. Excellent history for the long term. One to particularly hold for years and years and years, and will hopefully continue growing that dividend nicely to give you an absolutely fantastic yield on cost. Our next stock is also obviously in the tech sector. Sorry, it's a bit tongue-tied there. And our next stock is of course in the tech sector, and it is called Softcat, and is a constituent of the FTSE 250. Let's get in there, let's take a look, let's have a look at what this company does. Hello again guys, welcome back into the app. So as we first mentioned, the next company we are looking at is Softcat, and it is another pretty big tech company over here in the UK, and is an IT and software reseller. It does offers workplace data centers and networking, cloud-based solutions, which seems to be where every large tech company is going at the moment. Offers business intelligence tools and is diverse across all spectrums of the IT sector, including printing and IT addresses. That being said, let's have a look at the fundamentals here. So we have a market cap of 2.28 billion. Their ticker is SCT. Have a PE ratio of 33.40, revenue of 991 million, earnings per share of 34p, a dividend yield of 0.9%, a net income of 68.46 million, and a profit margin of 6.9%, and a debt to assets ratio of slightly high but not anything to be too concerned about at 69.96%. Has been doing particularly well of late, and has a 3-year and 5-year revenue growth of double digits, 14.46% and 13.8% respectively, and EPS growth of 3 and 5 years of 19.89% and 26.88%, which is absolutely massive in my book, and a 5-year compound annual growth rate of 18.18%, which is also absolutely awesome. And then just to top it off with the cherry on top, I know the starting yield is pretty low, however their 3-year dividend growth rate is 41.14%, which is absolutely enormous, and will top that 0.9% up in no time at all once you get hold of this company. It's also got 3 years of consecutive dividend growth. So currently trading at £11.47 a share, peaked just recently at £12.54, returned back to where it was pre-crisis at £12.60, so it completed that V-shaped recovery everybody was talking about, and then declined just down to where it is now. In the middle of the crisis, you would have picked this up for £9.07, which in my opinion would have been an absolute bargain and great to keep hold of for the long term. That being said, that wraps us up for Softcat. I'll see you back outside in the real world. Hello again guys, welcome back. So that was Softcat there, the second stock of this video. Really good company with what looks like quite a bright future ahead of it. Hasn't quite got the history that Sage has got yet, but does actually look like it's in really good shape going forward. And finally, we'll go on to our final stock now, and that is Computacenter. Let's get in there, let's check it out. I'll catch you back in there. What's going on again guys, welcome back into the analysis app, and here we are looking at Computacenter, a FTSE 250 constituent. As with the other companies, it is an IT infrastructure company, sells both software and physical hardware, also deals in supply chain logistics, networking, internet and e-gaming through public sector retail and printing services. Again, very diverse across within its sector, across the IT board. Let's have a look at some of the fundamentals. So its ticker is CCC, nice and easy to remember. Has a market cap of 1.96 billion, a PE ratio of 16.57, revenue of 5.05 billion, earnings of £1.4 per share, dividend yield of 0.59%, a net income of £106 million, a profit margin which is reasonably low actually, which is something I'd be a little bit concerned about at 2%, but profit is profit, especially when they've got a revenue as massive as theirs. And their debt to assets ratio is 74%, which is a little bit higher than we would like, but nowhere near the alarm bells ringing at 100%. If we have a look at its growth rate just recently, we have a 3-year and 5-year growth rate of double digits, 10.21% and 15.90% respectively, and that is reflected again in the earnings per share in terms of efficiency of 14.5% and 19.39%. And then we have a compound annual growth rate of also double digits, 15.06%, which is also an excellent metric to have. And then right there at the very bottom, 3 years dividend growth of 18.56%, which is also absolutely excellent. It has been growing its dividends since the early 2000s with 12 years of growth. However, they did cut it and trim it back in 2011 and 2019 respectively, but then they returned it to beating the previous year's dividends before it was cut, and then added some to that, so they kind of made up for the cut in the middle. However, that still obviously doesn't mean it can go forward counting as consecutive growth, which is a bit of a shame in terms of its history. That being said, that wraps us up for Computacenter. No, it doesn't, because I'm going to quickly run you through the costs. So it was trading today at £17.17 a share. Peak crisis, you could have picked it up for £9.68. Again, a bargain. You would have doubled your money, 100% return on this one almost. And pre-crisis, it was sitting pretty at £19.18. So there's still a little bit of money to be made on this one, but not as much as you would have made had you had the bottle to get in the midst of all this crisis. There's still a little bit to be made when it returns. And as you can see there, the chart is looking pretty good as well. A couple of spikes, but nevertheless an almost never-ending upward ticking curve. That being said, this time I mean it, I'm going to wrap it up here, and I'll see you in the outside world once again. Catch you out there. What's going on again, guys? Welcome back to the real world for the final time. That concludes my video there on the 3 stocks, Sage, Softcat and Computacenter. When pushed, it is pretty hard to choose between at least 2 of these stocks. I mean, I think Sage sits there because of its history in a league of its own, so that would be where, and obviously I have in my Freetrade portfolio, I've started a small position in it and I intend to add more. The other 2, there really isn't much in them in the fundamentals, to be fair. Softcat's got a slightly better history, but that's only a short history at the moment. So if I had to pick one, it would be a bit of a struggle. Anyway, I'm just going to leave it there for that one. I'm going to pick my one out of the 3, which is Sage, and that is obviously my favourite. I'm going to keep up with that. No one can compete or argue with 20 plus years of dividend growth and a growing share price over that time as well. That being said, I really hope that you've enjoyed this video. If you have, please hit the like button over here in that corner. These videos do take a little while to make, and it lets me know and lets YouTube know that I'm doing a really good job, and that hopefully that will bring the video to even more people. If you're brand new here, it's absolutely fantastic to see you, and it'd be great if you could hit the subscribe button over in that corner there, and even tick that notification bell as well to get notified when I release brand new content like this. All that remains to be said is a huge thank you for watching, and hopefully I will get to see you again in my next episode. See you again then. Bye bye.